First learning module of your level 1 derivatives, and this is the third video of this first learning module. In the first video we talked about the derivative features. In the second one we talked about the different underlyings such as stocks and bonds, and now we're going to talk about the features of the derivative markets. Now let's say there is a bank in America, let's say Bank of America, and there is also a bank in Mexico. So let's say Bank of Mexico, and lot of customers are there in Mexico who are, let's say, exporting goods to America, and there are a lot of customers in America who are exporting goods to Mexico, and they are worried that when they receive their Mexican peso, the value will change, and these guys are worried that when they receive their US dollar, the value will change. So what they do is all of them talk to their local bank and try and get some derivative contract from their bank to lock the rate of conversion of the Mexican peso to US dollar, or the US dollar to Mexican peso in this situation. So they both want to lock the rate. Now, what the Bank of America and Mexico bank could do is they could get into a back-to-back arrangement with each other to lock this rate as well. So they can deal directly with each other, right? And this is what we call over the counter. That this is the counter of Bank of America, and this is the counter of Bank of Mexico, and there is a person sitting at this counter, right? And there is a person sitting at this counter, and they just pick up the phone and they deal with each other. Alternatively, they could go through a exchange house, right, where instead of dealing directly, they both deal with this exchange house, and the exchange house does everything for them. Now, number one, if they deal directly, they can have a more customized deal, right? Because the exchange house usually has standardized options. That this is the deal, it's already fixed. You can sell 1 million Mexican pesos in advance, or you can sell 1 million US dollars in advance, or they could be standardized amount. Here it could be customized. The second point of an exchange house is that it reduces the risk, and specifically we're talking about counterparty risk, because there's an exchange house in the middle, right? So both the parties are dealing with the exchange house, and therefore the exchange house is responsible, and it reduces the counterparty risk. Here the counterparty risk is high, because what if the Bank of Mexico defaults or the Bank of America defaults, right? So counterparty risk is high because there's nobody in the middle. So this is basically your over the counter versus your exchange. So let's talk about the over the counter first. So over the counter involves directly between big companies, so banks and commercial banks, investment banks dealing directly with each other. Naturally, these are customized, as I told you, and can be non-standard terms, but the risk is that there is counterparty risk compared to the exchange traded options, right? And also less transparency is there. So this is like, you can say it's like a private deal happening between two big banks, and they trust each other and they're willing to take the risk, and they, as a benefit, what they get is non-standard terms, and they can customize the contract as per their both requirements, and this gives them the flexibility. So again, think of Bank of America here and Bank of Mexico over here, and maybe there's uh, Bank of Canada, and they're all just dealing with each other directly. And then you've got customers in Mexico and in Canada and in America, right? If they're dealing directly with each other, it is called over the counter. If, for example, they go through an exchange in the middle, then this will be an example of a exchange traded derivative. Now, what happens in an exchange traded derivative? Number one, they are standardized, so not customized, right? Not customized. And naturally, this is going to have a exchange in the middle. So what happens with that exchange is that the counterparty risk goes down, right? So this is very good because the counterparty risk is low, but obviously you don't have room for any customization. Again, another important benefit is that you get more transparency because everything is through a central party and everything is transparent and more liquid. Easily, you are able to get into and get out of the deals. There is a centralized clearing and settlement process, right, which includes verifying the execution of the transaction, the exchange of payments, the recording, and the final amounts and the delivery of the asset securities is done through the exchange, so that reduces the counterparty risk and provides a guarantee against the default of the counterparties. And how does this exchange provide this guarantee? Because they require each party, whether they're the long party or the short party, to post a collateral. So it's like both parties are required to deposit a margin or collateral with the exchange, so that if either party tries to default, their money will be used to make the other party whole. So, and if their losses exceed their margin, then more margin is required. So what they have is a margin call, where the exchange calls them up and asks them to put more money or additional collateral depending on the price movement of the underlying, right? So let's say there is a oil producer and there is an airline. Now the airline is worried that the oil price might go up, so they are going long, and the oil producer is worried that the oil price might go short, they might go down, so they're going short. And so in case it goes down, they will make money, and the airline will make money if the oil price goes up. Now what they do is they do it through an exchange. So this is exchange traded derivative, and they both have to put in some money, let's say $10 million each as deposit, and let's say the contract size is 100 million, and they both have to put 10 million as a security deposit. Now your oil price, let's say oil price goes up, it goes up by 10%. Now, if it goes up, obviously the airline will be happy. They will be happy because they are long the oil and they will get money. But the short party will be very sad because they will lose on this contract, and their $10 million will become zero. And they will have to deposit additional money if they want to stay in this contract, right? Now you might be thinking, what's wrong with this oil producer? Why is it making this loss? Actually, this oil producer is selling oil in the open market. So if the price is going up, they are benefiting from that in their normal business. So this loss is going to be offset from their normal business, and this is an example of hedging. So they're just basically locking the selling price. If it goes down, they lose on the derivative contract, but they win in the market. And if it goes up, if it goes up, they lose on the derivative contract and they win the market. But if it goes down, they lose in the market, but they win on the derivative contract. So they're basically just locking the selling price of their product. But how this is done through an exchange traded derivative is that the margin is required as a collateral, and each party is required to post a collateral when the trade is initiated, and then depending on the price movement of the underlying, additional collateral may be required. And everything is fully transparent and disclosed to the national regulator as well. And this is how it works. However, even with over-the-counter derivatives, now there is more disclosure, because what happened was in the 2008 financial crisis, there was a lot of over-the-counter private derivative transactions that were private. So the regulator didn't know about it. The financial system was at risk because of these very, very large over-the-counter derivatives. Now there is a new central clearing mandate, and what this requires is that even the over-the-counter derivatives have to be done through this central clearing counterparty, and this ensures that they can have their flexibility, but the counterparty risk has to be managed through the central counterparty. So even though you can say we want to do OTC because it gives us the flexibility, fine, you can have the flexibility, but the counterparty risk becomes too huge, and therefore to reduce that, what now you have to do is you have to have a central clearing central counterparty in the middle to take care of the counterparty risk. And how that happens is, so there's a 3-step process, and exhibit 7 from the curriculum shows us how that is done. So in the first step, the parties get into the OTC transaction, right? So let's say we're talking about an interest rate swap over here, but it also applies to other derivative instruments. It could be the same for an equity swap or any other derivative. So, but in this particular example, we're talking about an interest rate swap, that these two parties, they get into this interest rate swap like a normal way. And then what happens is that the details are submitted to the central counterparty in the second step. And then what the central counterparty does is that it replicates or replaces or novates. So this word novates, it means a new similar contract is created back to back, right? So this is replaced with the new contract, whereby these two parties, they don't need to deal directly with each other, but they deal with each other through a central counterparty, so that the counterparty risk is eliminated. So, okay, fine, you want to have a customized contract, you can have a customized contract, have it, submit the details to the CCP. The CCP is going to replicate or novate that contract for you, and then both of you have to deal with the CCP, and the CCP is going to manage the counterparty risk. The objective is to to eliminate the counterparty risk and still keep the customized nature of this contract. Okay, so this is the end of our first learning module of your level 1 derivatives. Let's have a look at the summary. We have 2 learning outcomes over here. The first one is define a derivative and describe the basic features of a derivative instrument. So we talked about a derivative deriving its value from an underlying asset. So important word, it derives its value from the performance of an underlying asset, hence it is known as a derivative, right? And it is a legal agreement where you have a long party and a short party. And then you can have 2 types of derivatives. One is a firm commitment, in which both parties have an obligation, but a contingent claim is where the seller of the claim of that particular derivative has the obligation, but the buyer has a right. Now that buyer could have a right to sell also, and they could have a right to buy also, depending on what is the type of derivative they are getting into. So if they are a buyer of, let's say, a put option, then they will have the right to sell. And if they are a buyer of a call option, right, then they will have the right to buy. So this is something that can get a little confusing, because here when they say seller has obligation, this is the seller of the option, not the underlying asset. Seller of the option. Okay, most common derivative underlying include stocks or equities, bonds or fixed income, interest rate. Your worried interest rate might go up. You could get into an interest rate swap. You could get into a future currency exchange where you give dollars and get euros, or give Mexican peso and get dollars. You could do it for gold, oil, or if you're worried that one of your major borrowers might default, so you could get into a credit default swap. And all of this expands the set of opportunities available to market participants to create or modify exposure to their underlying. Maybe they want to short sell, so if it goes down they make money. They want to diversify, so a lot of opportunities are there using derivatives. Now, the second learning outcome here is describe the basic features of the derivative markets and contrast over the counter with exchange traded. So, over the counter is, of course, having a customized benefit, right? Whereas exchange traded is standardized. And the benefit of exchange traded is that the counterparty default risk is low, because both parties are required to have a collateral. Now, however, for even over the counter, you have centralized clearing, central counterparty after the 2008 financial crisis, and this means that the counterparty risk is even lower for the over the counter, while you can still retain the availability of flexibility for your derivative contracts.